Welcome to Doc Does Financial History, where money, power, and history collide, and nothing is ever as simple as it looks.
You walk into the gleaming lobby of Lehman Brothers headquarters in Lower Manhattan. The walls are lined with polished wood, the hum of computers fills the air, and suited bankers move with purpose. You're carrying a briefcase stuffed with financial reports, balance sheets, risk models, and debt portfolios. Nothing extraordinary, yet everything about this building radiates power. This is Wall Street, 2008. And in just a few days, all of it will collapse. You head up to the 23rd floor, where the executives are deep in meetings. They're talking about mortgage-backed securities, collateralized debt obligations, and the dizzying returns they've been generating. You sit in the corner, watching them, listening. Everything seems normal. Until you notice something: the numbers they're cheering about aren't real profits. They're bets on bets, high-stakes gambling with other people's money. And underneath the facade of spreadsheets and power suits, the foundation is crumbling. Just days later, the phone rings. The CEO's voice is tense. Lehman Brothers is officially filing for bankruptcy. It's September 15, 2008. The shockwaves are immediate. The financial world freezes. Banks stop lending to each other. Stock markets plummet. Investors panic. And the global economy, which had been humming along for years on the assumption that risk could always be managed, suddenly realizes that it was built on sand. Lehman Brothers wasn't just another investment bank. Founded in 1850 as a small cotton trading company by the Lehman Brothers, Henry, Emanuel, and Mayer, it had grown over 150 years into one of the most influential financial institutions in the world. By 2008, it was the fourth largest investment bank in the United States, with over $600 billion in assets. It was a symbol of Wall Street's power and confidence. And yet, confidence is fragile. So how did a company with so much history and influence fall so quickly? To understand, we need to go back a few years to the housing boom of the early 2000s. Home prices in the United States were rising at an unprecedented rate. Banks were lending money to almost anyone who wanted a mortgage, even people with poor credit. These risky loans were bundled into financial products called mortgage-backed securities, which Lehman Brothers and other banks sold to investors all over the world. On paper, it looked like a brilliant strategy. The risk was spread out, profits were huge, and everyone was making money. But there was a problem. Much of the housing market was a bubble. Home prices weren't sustainable, and many borrowers couldn't afford their loans. Lehman Brothers, however, doubled down. The firm invested heavily in subprime mortgages, buying up risky loans because they promised high returns. They also borrowed massive amounts of money to increase their positions, a practice called leverage. For every dollar Lehman had, it had borrowed $30 more. That meant that a small drop in asset prices could wipe out the company entirely. And that drop came in 2007 and 2008. Mortgage defaults started rising. Subprime loans went bad. The mortgage-backed securities Lehman had invested in began to lose value rapidly. Suddenly, a company that seemed invincible was drowning in bad debt. Lehman tried to hide it at first, using accounting tricks to make its financial position look healthier than it was. They temporarily moved debt off the books, reported optimistic valuations, and continued to assure investors and regulators that everything was fine. But the reality was clear to those who looked closely: Lehman's balance sheet was a ticking time bomb. In March 2008, another major investment bank, Bear Stearns, collapsed and had to be rescued by J.P. Morgan Chase with federal support. This should have been a wake-up call, but Lehman's executives believed they could survive. They refused to sell the company or accept a bailout. The reasoning was simple: pride, fear of admitting failure, and the hope that the market would stabilize. But by the summer of 2008, the situation had become desperate. Lehman's stock was plummeting, creditors were losing confidence, and clients were pulling their money out at alarming rates. Now, imagine you're a Lehman trader during these final weeks. You're watching your bonuses disappear, your colleagues panic, and your firm teetering on the edge of collapse. Every phone call, every email, carries the weight of uncertainty. Rumors spread that potential buyers like Bank of America or Barclays are considering acquisition, but nothing materializes. Lehman is trapped. And then it happens: no government bailout. Unlike Bear Stearns, which had been rescued, Lehman is left to fend for itself. The bankruptcy filing on September 15, 2008, was the largest in U.S. history: $639 billion in assets, $619 billion in debt. Creditors scrambled. Hedge funds collapsed. Pension funds lost billions. Money market funds froze. The bankruptcy didn't just affect Wall Street, it rippled across the globe. Banks in Europe faced massive exposure. Emerging markets saw capital flight. Ordinary people lost jobs, homes, and savings. And yet, amid the chaos, Lehman's story teaches something crucial about human behavior. The same greed and overconfidence that built empires can also bring them down in a heartbeat. So why did Lehman fall when others survived? Part of it was timing. The market panic of 2008 was unprecedented in modern history. Part of it was leverage. Lehman's reliance on short-term borrowing meant that when creditors refused to roll over loans, the company was exposed immediately. But another part was culture. Wall Street had created an environment where risk was celebrated, not managed. Bonuses were tied to short-term gains, not long-term stability. Traders and executives took enormous bets, often without understanding the full consequences. In many ways, Lehman was the perfect storm of human hubris and financial engineering gone wrong. The collapse of Lehman Brothers also exposed systemic flaws in the global financial system. Regulators had allowed banks to take excessive risks without adequate oversight. Complex financial products like CDOs were poorly understood even by those trading them. And crucially, the too-big-to-fail mentality created moral hazard. Firms assumed they could take risky bets because the government would always step in if things went wrong. Lehman proved this assumption false, and the shock to the system was severe. In the days after Lehman's bankruptcy, credit markets froze. Banks stopped lending, fearing that any counterparty might be insolvent. Stock markets plunged worldwide. The Federal Reserve and the Treasury had to intervene with emergency measures, including injecting liquidity, guaranteeing bank debt, and creating programs to buy toxic assets. It was, in many ways, a modern economic war footing, an acknowledgement that if the financial system collapsed entirely, the consequences would be catastrophic. But the story doesn't end with Lehman alone. Its collapse triggered a cascade of failures. Insurance giant AIG needed a government bailout to avoid defaulting on credit default swaps. Merrill Lynch was sold to Bank of America to avoid bankruptcy. Even large commercial banks like Citigroup and Wachovia faced existential crises. Lehman's fall became the domino that revealed just how interconnected the global financial system had become. Risk wasn't isolated, it was shared, and when one major player fell, the effects spread like wildfire. Now, imagine looking back at the regulatory landscape. In 2008, many argue that reforms were overdue. Banks had become shadow banks, operating outside traditional oversight, engaging in risky behavior, and exposing themselves and their clients to massive losses. Lehman's failure became the catalyst for sweeping changes: the Dodd-Frank Act in the United States, tighter capital requirements, stress testing, and measures to prevent another too-big-to-fail scenario. But Lehman's collapse also carries a human story. Thousands of employees lost jobs overnight. Investors, from small pension holders to hedge funds, lost billions. Confidence in financial institutions, and in the idea of ever-increasing wealth, was shaken to its core. Ordinary Americans saw their 401(k)s plummet, their retirement plans evaporate, and their trust in the system crumble. And yet, many lessons were learned: the importance of transparency, risk management, and the dangers of unchecked greed. It's easy to focus on the numbers, the billions lost, and the mechanics of financial instruments. But Lehman Brothers is ultimately a story about decision-making under uncertainty, and the consequences when humans overestimate their control. The executives who refused to sell, who hid debt off the books, who bet heavily on rising housing prices, they were acting rationally according to their incentives, yet catastrophically for everyone else. Today, Lehman Brothers exists only in history books, documentaries, and memories. But its collapse still resonates. The global financial system has recovered, but vulnerabilities remain. Shadow banking, derivatives, and excessive leverage are still part of the landscape. And the lessons of Lehman, about greed, risk, and human behavior, remain timeless warnings. So when you walk past the former Lehman building on Park Avenue, now occupied by a different tenant, remember this: in 2008, one of the most powerful financial institutions in the world crumbled in a matter of days, dragging economies, governments, and ordinary people into chaos. And it all started with a simple human truth: unchecked ambition and overconfidence, when combined with complex systems, can have consequences far beyond what anyone imagines. The collapse of Lehman Brothers was not just a Wall Street scandal, it was a global event that reshaped economies, politics, and the rules of finance forever. And while new regulations have been put in place, the story is a reminder that the next collapse could be lurking just around the corner, hidden in the shadows of innovation, risk, and human ambition. Thank you for watching. If you want to explore more stories that shape the global economy and understand the forces that move the world, make sure to like this video, share it, and subscribe to our channel. And remember, history is not just about the past, it's a guide to understanding the risks and choices we face today.